This company has a yield better than the S&P 500 and is 35% undervalued. Hey guys, welcome back to another video here at FiscalVoyage. My name is Felix. So this video was created for Diedrich. Diedrich messaged me a few times, and he's a loyal supporter of my channel. He's always commenting and watching and liking my videos. So he was wanting me to do a video on Tyson Foods, and so here's this video for him. Thank you, Diedrich, for supporting my channel. I really appreciate it. In the description, there's a free ebook on 5 quick metrics to look for before spending more time in any specific companies. So go make sure to check that out. And let's get started with the stock analysis on Tyson Foods. And at the end of the video, I'm going to provide you with my recommendation, fair value price, and some of my thoughts. All right, Tyson Food Inc., ticker symbol TSN, is an American multinational corporation based in Arkansas that operates in the food industry. The company is the world's largest processor and marketer of chicken, beef, pork after JBS SA, and annually exports largest percentage of beef outside the United States. Together with its subsidiaries, it operates major food brands including Jimmy Dean's, Hellshire Farm, Ballpark, Wright Brand, Ades, and State Fair. Tyson Foods ranked number 80 in 2018 Fortune 500 list as the largest United States corporation by total revenue. So let's look at the fundamentals for this company. Tyson grew revenue at a compound rate of 4.5% from 2010 to 2019. Net income grew at almost triple the rate at 11.2% from that same time period. And the company has a great BBB plus credit rating, which is investment grade, so that's positive there. Operating income in that 10-year period grew at 6.6%, and earnings per share growth grew at 10.6%. And actually, in recent years, in the past 5-year average, earnings grew 14.7%, so it's much better versus the 10-year average, so that's a great improvement. Net income also grew for the past 5 years with an average of 13.4% annually versus the 11.2% for the 10-year period. And revenue, however, only grew 0.6%. Most of this increase in income and earnings is because margin has almost tripled for the company. So that's very positive. So they're making more profit with the same amount of revenue, basically, because the net margin increased. So let's look at fundamentals continued here. 2019 adjusted earnings came in at $5.46, net margin at 4.8% versus 2018 at 7.6%. So there was drop in net margin from 2018 to 2019. This year is expected to be around the 4.5 to 5% range as well, but we'll see because the company is going to report earnings sometime this month or in September, I think. Return on equity at 15.4% for 2019, and the current yield at 2.64%. It's not as a high dividend yield, but it's much better than the S&P index current yield, so that's a positive there. And the company outstanding dividend growth record or 5-year growth rate of 36.6%, which is outstanding, unheard of. So that's real good dividend growth rate. And the company only has a dividend payout ratio of 33.6%. Sorry there, I forgot the percent symbol there. And they've been growing dividends for 8 consecutive years. But also, the most recent increase was 12% in August 9th. But the company actually did not announce an increase. They actually are paying 5 consecutive quarters of the same dividend, so that's a little concern. They might be freezing the dividend, of course, with the situation that's going on with the economy and stuff. So they're probably, being conservative here and holding before they increase, because the dividend payout is only 36.6%, so they have plenty of space to increase the dividend. And earnings, if we go to the next few slides, you'll see they're still well covered. The company has a charter rule of 36.2, which is the 5-year growth rate of 36.6 plus the current yield. So that's really good. I like to see a charter rule of 11, 12 and higher. So that's very positive there. And the 5-year dividend yield average is only 1.49%. So the company current yield is 2.64. So it's almost 100 basis point higher, over 100 basis point higher than the 5-year average. So that's a good indicator that it might be undervalued. And so let's look at the balance sheet for this company. Debt to cap is only 42%, so it's modest. It's not too high, but not too low. Current ratio of 1.8, so that's better than my criteria or minimum requirement of 1.5. I like the 1.5 and higher, so that's a positive there. Debt to equity is real good. I only 0.81 ratio, so that's real good. So they have debt very under control. And as you remember, the S&P credit rating is BBB plus, so their balance sheet is looking real good with an interest coverage of 5.85. So that's real good there that they're able to cover the interest. So that's a positive there. And the price to book ratio at 1.6, which is lower than the 5-year average of 2.1. So that's another indicator that the company may be undervalued. But again, later in the slides, we'll talk about the fair valuation for this company. So let's look at the future outlook here for Tyson here. 2020 expected earnings to be $4.98. This is, however, lower than the 2019 earnings of $5.46. So, with the economic, restaurants are, in the beginning of the year, restaurants weren't open, so they weren't ordering, chicken, beef, foods of that nature. So you can see why earnings are lower expected for 2020, and they earnings or the fiscal year ends in September, so shortly they'll be announcing the quarterly report for the fiscal year of 2020. 2021 expected earnings, however, is expected to be much higher at $5.79. So this is higher than the 2019 earnings of $5.46. So that's very positive here. I like that. Earnings are expected to be higher than last year, so that's very good. And what I found, analysts are expecting around 8% or 9% earnings growth for the next 3 years. So that's a plus there. So that's another positive outlook here for this company. And of course, they provide food for, restaurants and the food distributor. So, and, people eat. So this is why, this is a positive company here. And my dividend yield return model projected total return annually of 11.7%. So that's very positive. I like 9% and higher. So this is beat that criteria very well at 11.7%. And based on PE ratio, currently the company has a PE of 12.5, which is based on 2019 earnings. Forward PE of 12.7 is based on 2020 expected earnings. So versus a 5-year average of 13.7. So that's another good indicator that the company may be undervalued. So let's take a look at some the fast graph for Tyson. So here's the fast graph for Tyson Food Inc. As you can see here, the company earnings looks to be erratic. There's been time where I had negative earnings where they didn't make any profit here at 2006, but picked up greatly by 303% in 2007. But ever since 2010, it looks like here, the company earnings has been growing, or 2011 has been growing since then very nicely actually. You can see here 32% growth, 39%, 21%, 16%, so double-digit growth in from 2015 to, or 2014 to 2018. Last year, for 2019 fiscal year, the earnings dropped by 11% to $5.46 versus $6.16. And this year, of course, with the economic situation that happened in the beginning of the year, earnings are expected to be down 9% to $4.98. However, you can see here, earnings are expected to pick up quite nicely in 2021 and 2022. I think there's that pent-up demand of people wanting to go back to restaurants and things like that and eating out. So we've shortened down this period. You can see the black line again is the monthly closing price, and the orange is a earnings with a multiple of 15, and the blue line is a normal multiple or PE of 13. So I like to be conservative, and we'll stick with the fair value of 13. You can see here, based on this, the company can have a total annual rate of return of 21.7% if it goes back to that mean of 13 PE once 2022 earnings of $6.94 come to fruition. So that's tremendous annual rate of return of over 20%. So that's real good. And the company has a nice dividend of 2.67 and a blended adjusted earning yield of 8. I like to see this at 6.5 and higher. So you got an 8% earnings yield, so that's real good there. As you can see here, S&P credit rating of BBB plus, and a long-term debt of 42%. If we look at the forecast, it's Also good here, analysts, there's what we got here, 13 analysts analyzing this company. And you can see here 3 months ago, they had earnings of $4.20. So they actually been upgrading to $4.98 now. You can see here for 2021, it did drop from $6 to now $5.79, but still much higher than 2019 of $5.46. So that's positive there. So you can see up to 2021, you can have that 20% plus annual rate of return. So that's very positive with a very nice dividend yield. Let's look at the free cash flow because that's what covers the dividend. So if we look at the free cash flow, you can see Tyson Food is very well covered here. The dividend is very well covered. It's only about, I think, 30%, 31% payout ratio based on free cash flow. So that's very positive. So the likelihood of a dividend cut is very unlikely. But like I mentioned, the company did freeze the dividend. They haven't increased the dividend. There's been 5 quarters already with the same dividend payment. They should have announced a dividend increase earlier this month, but they didn't. They announced the same payment. So, that's, even though they have expected a lot of free cash flow, they're being just conservative and being safe here and saying, the uncertainty of the economic, that's why they're not increasing the dividend. But I think once next year comes, about August, they will definitely announce a double-digit increase in dividend because, like you see here, there's plenty of space, well-covered dividend. So that's very promising. And let's look at the analyst scorecard here. As you can see here, it's pretty, give or take, 45% miss and 45% beat and a 9% hit. So analysts have been missing for the most part of the time. So, I'm not 100% confident with the earnings, but I could definitely see for 2021 the $7.79 because of the pent-up demand for people wanting to, go out and eat. Of course, there's another shutdown. All this is going to go away and probably go in a downtrend. But I personally don't think there's a chance for another shutdown because of the vaccines and other ways of treating people for the virus. But this does look very promising. You do have a company that's undervalued based on the fast graph and a projected total annual return of 20+%. So that's very positive. So I like the fast graph here. I like what I see here. So let's look at the fair value prices slide here. CFRA has a fair price of $95.83. Morningstar at $84. Fast graph, as you just saw, $82.46. This is again based on the 2021 expected earnings. And Yahoo at $73.41, and my dividend discount model analysis at $90.72. What I used for this analysis, I did an 8% for the next 3 years and 8%, going forward. So 8%, for a long period of time of growth because the company does have plenty of room for dividend increase of 8%, and earnings are expected to increase for the next 3 years about 8%, and maybe with the substantial space they have in the payout ratio with a nice earnings growth of 8% or higher, or maybe even lower at 5%, they could still continue to grow dividends at 8% before it becomes risky there. But averaging out to 5, we get a fair price of $85.28, and currently the company goes for a whopping $63.24 as of this presentation. That means the company is undervalued by 34.9%, and this is why I had the company as a buy recommendation at current prices. So there you have it. Tyson Foods is very undervalued. This company looks very safe. The payout ratio is very good at under 35%, which is great. The balance sheet is looking good. The expected growth is looking good. Earnings are expected to be higher in 2021. It's going to be down this year versus 2019. But of course, with the economic situation, what happened in the first half of the year is understandable. But overall, the company looks in real good position. BBB plus credit rating, so it's investment grade. I personally don't own shares of this company, but after doing this analysis of the company, I think I need to start buying shares because this one is something that's is a boring company, but it makes money. Of course, because people have to eat. restaurant order their food and the beef and chickens and stuff like that. So this is very promising. So I think it's a great opportunity for you guys to check out Tyson Foods. Make sure you do your own research. Again, when I say a buy recommendation, doesn't mean you go out and buy it. I think it's worthy of your time of research. So make sure you spend your time, research the company, but I think it's very promising right now. And thank you for watching. And again, check out the free ebook that I have in the description. And if you're new to the channel, make sure to hit that subscribe button. And if you like the video, hit that like button for me for the YouTube algorithm. And thanks for watching. I'll see you guys in the next one.